Good morning. Where Americans can't afford homes and where buyers still can. Most Americans cannot afford homes currently for sale, and where you live matters more than ever. And U.S. housing affordability remains severely constrained. As of July 2025, more than 75% of homes on the market are unaffordable to households earning the national median income of roughly about 80,000. And across the 34 largest metro areas, only 23.5 of listings met those standard affordability thresholds. So this isn't just about mortgage rates. It's the combined effect of elevated home prices and limited housing supply and uneven construction activity across the regions. So let's look at where homes are most affordable. And affordability improves meaningfully in parts of the Midwest, the Rust Belt, and select southern markets where prices have grown more slowly and supply constraints are a little less severe. So some markets are offering the strongest opportunities for middle income buyers. And let's take a look at a few of those. So Pittsburgh, approximately 55% of listings are considered affordable. And in St. Louis, roughly 50%. And in Baltimore, Detroit, Cincinnati, Birmingham, around 40% affordable for buyers willing to be flexible on location or open to relocating. And these markets present realistic ownership paths with standard mortgage structures. So let's look at where homes are least affordable. Coastal metros and high growth Sunbelt cities remain largely inaccessible for median income households. So let's take a look at a few examples. Miami, just 0.4% of listings are considered affordable. And in Los Angeles, fewer than 2%. And in San Diego, also similarly below 2%. So in these markets, price growth has far outpaced income growth, and supply shortages continue to push affordability further out of reach, even for high earning households. So why the math doesn't work for most buyers? Well, let's take a look at this simple analysis. And we're assuming a 20% down payment and a 6.8 30-year fixed mortgage rates and housing costs capped at 30% of your gross income. So under those assumptions, the median US home price of 435,000 requires household income of roughly 113,000 per year and about 33,000 above the national median. So that gap right there explains why many qualified buyers feel priced out despite stable employment and strong credit. And supply is the real constraint, and that's the elephant in the room. And housing supply is diverging sharply by region. So the South and parts of the West have added inventory through new construction, which is improving long-term affordability outlooks. In the Northeast and the Midwest remain 40% to 60% below pre-pandemic inventory levels, which keeps pressure on prices despite slower population growth. So builders are now adapting, and townhomes now account for 18% of single-family construction, nearly double their share a decade ago, making them one of the most important affordability levers for first-time buyers. So what this means for buyers: even if mortgage rates decline, and they likely will, affordability will not meaningfully improve without sustained increases in housing supply, especially in job-rich, high-demand metros. And the point here is this is where mortgage strategy matters, and buyers who understand market-specific affordability, alternative loan structures, and first-time buyer and professional programs will continue to win, even in constrained markets. That, my friends, is it for the day. Please visit my website, billraponline.com, to figure out how to get a hold of me, and love to talk to you more about your situation. Have a good day.